My name is Greg Remke. I direct a program called Economic Thinking. I give talks at workshops, debate camps, debate clubs, and this is on the banking, finance, and monetary topic. Just an overhead linking to recent articles here in March 2020 relevant to the debate topic. So Investment Powers Growth is the title of the presentation. Our website is down temporarily, but we do have posts on a Facebook page, Economic Thinking Monetary on Facebook. So I'm drawing here from March 9th article in RealClearMarkets. The coronavirus is priced, but government responses aren't. The concern here is government reactions around the world to the virus can be disruptive, and this applies to fiscal policy, that is government stimulus. Let's give everybody money who's not working. Let's pump money into the financial system. Monetary policy, any of these approaches by the government in responding to this problem is antithetical or disrupts the natural process of responding to a disaster, whether it's a meteor striking the earth, a giant volcano, a tsunami, in this case a virus that's disrupting supply chains and everyday life across the U.S. So I'm going to draw from that, but also make points I hope are relevant to the current debate topic for the Stoa League. So important to understand that consumption follows production, and that follows investment. So efforts by the U.S. federal government or the European Union to stimulate consumption, saying, look, we have a problem, the economy is declining, we need to stimulate consumption. That's not really the nature of the problem. The coronavirus is stopping people from working. It is cutting production. So just boosting consumption with finance or fiscal or monetary policies can be counterproductive. But it's worth understanding the background of how we get prosperity. We're going to take a hit from this virus and the economic downturn, but where does prosperity come from? It comes from finance and banking. It comes from investment. Investment powers economic growth. These are quotes from the article in RealClearMarkets. Basic for economics, we have endless consumptive desires. You would make a list of everything you wanted. It's endless. That doesn't mean we're materialistic or greedy or anything like that. It's just whether it's violin lessons or travel or a new car, everyday people want things. But before we can have those things have to be produced. So part of what we do to get the things we want is we work. We work for ourselves or we work for other people. We create wealth that with our labor that can be exchanged for income we use to buy other things. So we have endless consumptive desires, but as individuals we know we can't get all these desires absent production. We have to work first. Now, if you're a restaurant worker, you're stuck right now because restaurants are closing down because people are afraid to go out. So that's a problem. That's why we have savings. That's why we have money set aside for when we get sick or society gets sick. But consumption is the consequence of production. It's investment that powers production. So the more investment we have in our capacity to produce, those resources boost our ability to produce. So consumption comes after production. And the role of investment, the creation of tools, machinery, software, that comes from people who first accumulate savings, who set aside consumptions, have savings, and that savings is invested in companies. So, part of why Americans are so wealthy on average is, there's hundreds of thousands of dollars of machinery behind every single person in the country. That is, you count up the total amount in farm machinery, factories, ships, boats, cars, the things that multiply our productivity. That's a vast amount of wealth that's been invested by companies, by our parents and grandparents. Countries that are poor in Africa and Latin America, they lack the capital investment in the factories and machinery to multiply their productivity. So they're in Asia, planting rice by hand, Well, farmers are much less productive with, an ox and a hoe, things like that, compared to modern farm machinery we have in the U.S. So we benefit from this technology. This technology requires investments, and those investments come from banks, from finance companies, from investors, the stock market, the bond market. And the decisions have to be made about what to invest in. In California, should there be high-speed rail between San Francisco Bay Area and Los Angeles? That's a decision, could transport people really fast, but cost billions of dollars. So should it be built or should it not? Who's going to put up the money? The federal government, state government, taxpayers, or private companies? Those investment decisions about transportation, infrastructure, and technology, about agriculture, topics that have been past STOA debate topics, those come from the banking finance system. And the banking finance system that we have is regulated by the state and federal governments and part of monetary policy. So this is a sort of a background article on sort of the overall economy, the banking finance system. My previous talks linked to economic articles that provided more of this. So we have a basic question, why? Used to be everyone was poor, everyone was a farmer. People were making, clothes and shoes by hand and weaving them. The tools and technology and investment in agriculture, fisheries, textiles, mining, energy, all this stuff is the core of what's made Western society, Japan, US, Europe, so stunningly wealthy. And prosperity has been increasing. The economic challenges are a coordination problem. Innovation, how do you decide what kind of cars, what kind of factories, what to produce? Those decisions are made by entrepreneurs and enterprises, and banking is a key part of that. Banking, it's part of the theory of ultimate decision making. Who's going to decide whether the U.S. economy, has more electric cars or gasoline cars, or more solar and wind power, or more natural gas or nuclear power? Those decisions should be made by investors, but they tend to be affected by policy, whether it's banking policy. The federal government can sort of block people from investing in fossil fuel companies. That's been advocated by progressives, the Sanders campaign and the Warren campaign. They want to stop funding fossil fuels. They think that's better. Well, the question is, who makes these decisions? The government through regulation or the private sector? We already have federal policies that have tried to lock out financing for payday loan companies, for other companies that are considered disreputable or bad in some way or the other. So these decisions, politics influences banking and finance. Again, production's key to prosperity. Investment and innovation boost production, consumptions after that. In a financial downturn, like we're having now as the stock market falls, what's the role of the Federal Reserve? Should they lower the interest rate as part of monetary policy? Should the federal government or state governments increase spending as part of fiscal policy to boost demand? Those are political decisions to try and respond to a downturn. But this article argues that both of these are based on outdated and exploded Keynesian economic theories that were popular in the 50s, 60s, and 70s, but then sort of fell apart in the 80s and 90s, but still have advocates in academia and politics. So investment is needed to reorganize economy after this downturn with the coronavirus, but many are calling for more stimulation, that is more funding just to go to